If you bought silver, you made twice as much money as you did owning gold. And it could even be more than that. So I think we're in the same situation with silver versus gold and miners versus gold. We're on the cusp of the new money flow, largely from a broken U.S. stock market bubble, seeking alternatives. And frankly, if you do the math, you'll see that silver, it's up around 40% over the last 12 months, February to February. Silver's a dog. Okay, well, fine, whatever you want. We see it not as a dog, but as a dog on a leash that's ready to run out in front of the mama market and pull the mama market. So that's what we see for 2025 is probably the best place to be.
Silver, often seen as gold's undervalued counterpart, may be on the cusp of a significant market shift, according to market analyst Michael Oliver. The silver-to-gold ratio is currently at a relatively low 1.14%, indicating that silver is worth just over 1% of the value of an ounce of gold. However, historical data shows that over the past 50 years, there have been at least 20 years where this ratio reached 2% or higher. If silver were to regain this level, it could represent a substantial price increase relative to gold, suggesting a potential surge in silver prices. Oliver notes that such shifts in the ratio often precede strong moves in silver, making this an important moment for investors to watch. The fundamentals driving silver's potential growth extend beyond its traditional role as a store of value. Silver is a critical industrial metal, with growing demand for its use in solar panels, electronics, and electric vehicles. As the world increasingly turns toward renewable energy, silver's industrial applications are set to expand. Meanwhile, mining production has struggled to keep up with this demand, creating concerns about future supply shortages, which could further support the metal's price. Oliver suggests that as this supply-demand imbalance worsens, silver could experience an explosive rally similar to previous cycles where it significantly outpaced gold. Over the past year, silver has outperformed many other asset classes, rising by approximately 40%, more than double the 16.8% gain in the S&P 500. Despite this impressive performance, silver remains largely overlooked by mainstream investors. However, seasoned investors recognize that periods of neglect often precede breakout rallies. Oliver emphasizes that as economic instability, inflation, and a weakening stock market prompt more investors to seek out safe haven assets, silver stands to benefit from an increased flow of capital into precious metals. If the broader market faces a correction, silver could emerge as one of the most attractive investment opportunities, offering both a safe haven and substantial growth potential. We present the clips of Oliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Well, actually, as I said, it's done very well versus gold over the last year. It's really not underperformed, as most people think. Why? Because silver has these bigger pullbacks. And therefore, but you measure, if you're an investor, you don't care about this week or that week. You're looking at month to month, et cetera. And maybe don't even look at it till the end of the month. Say, what happened last month? Okay. And it's very good. But its spread relation to gold is very cheap still. It's 1.14%. Divide an ounce of silver into an ounce of gold. Now, if you go back 50 years and look at each year, how high did silver get on a percentage basis to an ounce of gold in that 50-year period? 20 of those years, it reached at least 2%. Whoa. Okay. If we break out over the near-term action, then we plot it. There's a nice downtrend line on that spread right now that since that October high in silver at 35, the spread made a peak then, and it's created a very clear downtrend structure. So when you break out above it, it's saying, okay, I'm back. Okay, silver's going to outperform. If you just take it from 1.14% up to 2, which is normal, 20 years out of 50 is hardly abnormal.
Right.
And say, oh, I'm back to, normal. That's a doubling of the price of silver in relation to gold. So, over the next year, if it went to 2%, that means if you bought silver, you made twice as much money as you did owning gold. And it could even be more than that. So I think we're in the same situation with silver versus gold and miners versus gold. We're on the cusp of the new money flow, largely from a broken U.S. stock market bubble, seeking alternatives. And frankly, if you do the math, you'll see that silver, it's up around 40% over the last 12 months, February to February, okay? S&P, I just checked, up 16.8%. Okay, I thought the stock market's beating the pants off gold and silver. Okay,
Right.
Up 16.7% last 12 months, February close to February close, and silver's up more than twice that, and yet nobody's cheering. Silver's a dog. Okay, well, fine, whatever you want. We see it not as a dog, but as a dog on a leash that's ready to run out in front of the mama market and pull the mama market. So that's what we see for 2025 is probably the best place to be. And I think this pullback, consolidation, et cetera, is just more repetition of, if you look at a silver chart of the last year, it went from 25, 26 up to 35. Now it's trading either side of 32. Okay. But if you bought every 10% pullback that you were offered in that move, you're beating the pants off the guy who just chased the highs. Okay. Every time it looked dark, buy it, because the big picture says it's light, not dark. So anytime the mobs say, "Oh my God, that's the top. We're going to correct for 8 months. It's going down 50%," buy it. And that's been the lesson of especially of the last year. Historically, the T-bonds and gold have beat the S&P during bear markets, and there have been periods in those bull markets in gold and bonds where S&P was going down, and there might have been a month where gold had a bad month too, but basically it was part of an uptrending process. And I think we're at that point now where if you break the stock market, that money flow will cause acceleration in this arm wrestling bull trend that gold is in, and the miners and silver. And I think you'll notice a tonal difference. And be there before the mobs. Okay. Let the mobs chase it. That's fine, but get there before. And that's what we're trying to time is the spread breakouts, because those spread breakouts often are very well timed to the points of acceleration in price. This was true back in the 1979-80 bull and back in the 2010 to 2011 phase of that bull market, where the spreads broke out and silver beat the pants off gold in that last year. I think we're on the cusp now.
Gold's recent surge to near all-time highs has sparked renewed interest in the precious metals market, with market analyst Michael Oliver predicting this is only the beginning. He believes the current stock market, which he characterizes as a bubble, is ripe for a correction, noting the S&P and Nasdaq's flat performance since their July highs as a sign of underlying weakness. Oliver suggests that a 5 to 10% drop in the stock market could trigger a significant shift in investor sentiment, prompting capital to flow towards safer assets like gold and silver. Historically, gold has served as a reliable safe haven asset, particularly during market turbulence, offering stability while equities falter. As the financial landscape remains volatile, Oliver emphasizes that the prolonged bull market in equities has been driven by overvaluation, making it vulnerable to a correction. He predicts that gold will be the primary beneficiary once the stock market starts to break down as investors seek refuge in tangible assets. With the possibility of a market downturn growing, Oliver believes that the capital flowing out of the stock market will increasingly find its way into gold and silver, reinforcing their roles as key assets for wealth preservation during uncertain times.
I think we're set up for another major top and downturn. Except
in the stock market.
It should be worse, in the stock market. And I think that's the key factor for gold people to pay attention to now. Because when that guy goes, when the money flees, it goes somewhere else. It has always gone into gold. If you go back and examine .com top, 2007 top, mid-1970s, gold roared up to 1975 while the stock market was getting killed. In fact, it crashed in 1974, the stock market. So total opposites, including back in the 1930s, when the Dow dropped 82% between 29 and 32 low. They didn't have gold because it was illegal, but home stake mining traded, went up like 1,000% because gold miner. So gold is the alternative. So don't be deluded by tick comparisons of, today's down, so is gold. S&P had an hourly rally, so did gold. Don't get deluded by the micro because the macro is different. And gold is going to get an infusion of new capital by investors who suddenly say, oops, I need to get out of this. And not all the money gets burned up in flames. It moves. Another place it'll move will be T-bonds, and they're already starting to now catch up to what gold has already been saying.
Right.
With that money flow.
Right.
That's the other alternative. So anyway, I think that's the thing for gold people to watch now. Crashes are unusual in markets. In 29 we had one. In 87 you had one, but in 87 the crash ended, and that was the end of the correction.
Yeah.
Because it was only breaking certain metrics, and its annual momentum fell down to support in that crash. So it didn't break that long-term structure. In our case, we have a different situation now. We have the oldest bull market, 15 plus years old. It's 18-fold for the NASDAQ 100 upside since 2009. It's 8 or 9-fold for the S&P. There's no prior bull market excessive top, we call bubbles like the dot-com, that matches this whatsoever. And so when it breaks, it's going to be nasty because errors occur in such bubbles. Mm-hmm. Personal errors, investment errors, corporate spending errors. And suddenly when you rip away the fakery, the false notion, the price of money, for example, being artificially kept low for 15 years, even with the recent rate rise they gave us, that still reached levels that if you look back 50 years, you say, that was a rate rise? It's still very low. And 10 of those 15 years, it was zero. Okay, so you talk about drug taking, in the arm, the Fed was providing drugs to the market that was accepting that flow at the time. It would be the stock market. Those things change. Whenever you break the stock market, if you go look, you'll find gold and T-bonds. That's where the money then flows. And you can bet that the Fed is going to turn on the spigot when they get data points that start to show what stock market tops always produce, negative data points after the fact. Mm-hmm. And the Fed will be panicked. They don't want to cut because it's Trump, they don't want to help him out. But they're going to have to. Even their friends won't like it. Academic friends won't like it. You waited too long, guys, Anyway, that's going to help infuse the next more accelerated move in gold.
Gold and silver assert their dominance as essential safe haven assets, attracting investors amid growing economic uncertainty. With inflationary pressures, shifting trade policies, and geopolitical instability shaping the financial landscape, demand for these metals is expected to strengthen. Gold, in particular, remains a preferred store of value, with its limited supply and increasing central bank reserves reinforcing its role as a hedge against market volatility. As stock markets show fragility, investors will likely seek refuge in gold, pushing prices higher in the coming days. While historically more volatile, silver holds immense potential due to its dual function as an industrial and investment metal. With its critical role in sectors like renewable energy and technology, silver's demand is poised to grow, further supporting bullish price action. Analysts anticipate that gold and silver will continue their upward trajectory, especially if economic uncertainties trigger a broader flight to safety. As investors and institutions increase their exposure to precious metals, these assets are expected to remain a key pillar of wealth preservation and financial stability. Share your thoughts on Oliver's analysis in the comment section below. If you find this video informative, don't forget to support your finance log team and turn on notifications to stay informed about our latest videos. See you in the next video.